From the morning reading, the SPDR volume jumps as the SPDR, Diamonds, and IWM, XLB, and XLY all hit new all-time highs. Breadth strengthened compared to the prior session as advancers led 2310 to 720 on the New York Stock Exchange and led 1804 to 988 on the NASDAQ. Oil futures were down $1.07 to close at 49.81. On the S&P 500 snapshot, the Trump rally accelerates to another record close. Equity indices around the globe rallied again, and the benchmark S&P 500, along with its elderly cousin the Dow, surged to new record closes. The 500 hesitated, and the open traded sideways until late morning and then began a steady soar to its 1.32% record close, just a tick off its intraday high. The equity surge coincided with President-elect Trump's new accolade as Times Person of the Year. The yield on the 10-year note closed at 2.34%, down 5 basis points from its previous close. The Dow indices are confirming new highs. Both the Dow Industrials and the Dow Transports closed at all-time highs on Wednesday for the first time since May of 2014. Many investors use that as a clue of a healthy economy and thus a good sign for future stock prices. Going back to 1930, the evidence is mixed in that regard and definitely not in their favor shorter term. It wasn't just the Dow. More than 400 securities in the New York Stock Exchange set a 52-week high on Wednesday, accounting for more than 13% of all issues on the exchange, the most since 2013. When stocks are setting a multi-year high, such a surge in participation can mark exhaustive buying interest, but it wasn't a consistent enough signal to be useful. Short and medium-term risk is high. There have been 23 days since 2000 when medium-term risk was 7 or higher and short-term was 8 or higher. Over the next week, the S&P 500 showed a positive return 7 of the 23 events. After only one of those events did the S&P rally more than 1% at its best point during the next week, but it lost more than 1% at its worst point 9 times. The S&P was negative more than positive up to a month later. The VIX rose despite gains in stocks. The last time the VIX rose 3% on a day the S&P 500 rose 1% to a 52-week high was at the peak of the 2000 bull market, March 23, 2000. Over the past 30 years, there have been 38 events when the VIX rose 3% despite the 1% gain on the S&P. The most consistent performance going forward was 9 days later when the S&P was higher 15 times for a 39% win rate and an average return of a negative 0.1%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:18 a.m. Mountain Time, and I am recording this in preparation for the market day of December the 8th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were up just above scratch. Crude oil was up about 0.5%. Euro was up just above scratch. Long bonds were down about 0.75%. Gold was down about 0.25%. China was down about 0.25%. Hong Kong up about 0.25%. Japan up about 1.5%. Germany actually is up about 0.5%. And the United Kingdom is up about 0.25%. In terms of macroeconomic reports for the United States for today of note, you have the weekly unemployment claims and the nat gas storage. Looking forward to tomorrow, you have the University of Michigan Consumer Sentiment Report, which will be released during market hours. In terms of current volatility conditions, you did hear one of the morning authors mention how volatility was actually up yesterday despite the record performance by the market. The Short-term VIX is now at 11.79. Skew did fall and is now below the caution threshold. IV percentiles, 13 for the S&P, 14 for the Russell, 17 for the NASDAQ, 14 for the Dow. We did have significant moves put in on all four of the broad U.S. indices yesterday, with 2 standard deviation moves on the S&P, the NASDAQ, and the Dow, followed by a 1 standard deviation size move by the Russell. In terms of current charts, let's go ahead and go there. We'll take a look at the S&P futures first, and you can see the overnight action has been somewhat positive behind yesterday's very, very impressive bullish activity. And while we have to say that, you know, coming out of the election and having this was election night and election day, day after I should say, you had the big breakout of the diagonal resistance on that day, and that was followed through with a move up to the resistance area and then through the resistance area, legging up to new all-time highs, followed by a bull flag, a test of the old support, an undercut of that support, followed by a huge bullish move up, confirmed, and then followed once again to new all-time highs with yesterday's action. Of all that action, perhaps the most impressive was yesterday. With this action here, this was all, you know, while short-term very bullish, was within the range. This action here, you know, you wondered if it was just an overshoot from this post-election elation. And then, of course, we had the somewhat high probability expectation of a retest. You had the undercut, but then that was then followed by this big bullish move. So you felt, well, okay, this is starting to really mean something, to where we have higher highs and higher lows. And, you know, let's see if we settle into a trading range. Well, indeed, with yesterday's action, we made a huge, bold statement that, no, this is not about trading range, at least as of yet, and we're going to bust out. And this is really the first sign that I would say in this some 3 weeks of action where you could really make a statement that maybe this time is going to be different than the last 2 years, where we would make moves from one side of the range to another, and then maybe an incrementally small new high just to settle into a new range. Well, this may be the first evidence that that's not going to happen this time. So I'm not going to minimize how bullish this move was yesterday, and it was done on volume. You see here also the Dow. Dow never even went into a bull flag. It just simply broke out of its recent highs and had a huge statement day, also going to a new high. The Russell also very much in the same kind of pattern. You had this big kind of exhaustive move after 15 consecutive days. You had a bull flag that came back into the channel, but then blew back up through the channel, confirmed, and then added to that. Now, this was the weakest move of the 4 indices yesterday, in that it was in relative terms only a 1 standard deviation move to the others 2 standard deviation moves. But remember how far the Russell had already come. So very, very strong new high was put in, and then that was also done, you know, on a big significant move with volume. Then, of course, there's the NASDAQ. The NASDAQ, of course, has been the one that has still been in range. Now, you did, with yesterday's action, have a cloud breakout. So this is on the bullish side of the trading range. But it has still got some work to do to be able to take out its area of resistance, which is above. So big move on the NASDAQ, not going to minimize that, but yet at the same time, it still has yet to make those all-time highs. In other markets, crude oil was down, and commodities were one of the few red spots yesterday. And you had, with yesterday's action, you know, a pretty big retracement coming down off the recent swing into the area of resistance. So this resistance continues to hold until it doesn't, and pretty significant area to use as a target if you're a short-term trader in crude oil. In terms of gold, gold has been in a multi-day consolidation. It was up slightly yesterday, so it was one of the few commodities that had a positive day. Many of the commodities, we'll take a look at the composite ETF. You see they had a negative day yesterday. So many of the commodities, of course driven by crude oil, were down. Gold was up though. In terms of other, let's take a look at the bonds. Bonds has been in a sideways consolidation pattern, though is currently pushing down in this morning's activity. And the dollar, that was one of the things I checked yesterday as this day was developing was the dollar having some sort of big move? And not really. I mean, the dollar was down yesterday, which certainly helps, but nowhere near the kind of size candle that you'd had several days prior, for example. So this was not certainly wholly attributed to a move by the dollar to power yesterday's move. This would seem to be, something else than a dollar or currency explained move. And then volatility. Volatility, of course, yesterday actually going up with the rising equities, though still, this is the noise range, this 12 to 15 that you get with volatility in a normal bull market. That's where it was yesterday. Now, the low of the day was in the low 11 handle, and you have the 52-week low at 11.02. This certainly is at the lower end of normal volatility, so it's hard to make too much of anything that happens in a 11, 12, 13 kind of range on volatility. That's all very low action. Okay, that should be enough on that today. Let's go ahead and go to the daily report where we've had some significant changes. First of all, we still have it as market phase 4. I thought it may indeed flip to another phase with yesterday's action, but it didn't quite make it. Price patterns near resistance or extension is still the description here. This is a bullish phase, so certainly would love to see the bull phase 3 with the bull flag patterns as kind of the dominant setup. In terms of the market timing signals, important changes here from yesterday. Remember, these are all three mechanical in nature. The first one comes to us from IBD. Confirmed uptrend has resumed, and that is a bullish signal. GMI index is a 5 out of 6 with a very sensitive GMI 2 at an 8 out of 8. That buy signal has been in place since 11:10. And then on stock charts decision point, we also had significant changes yesterday with 2 new short-term buy signals on the NASDAQ. So that gives us universal short-term buy signals on all 4 of these setups, and then a majority bullish signals on the intermediate term, but we still have some mixed signals on 3 of the 4 indices. Also mixed signals on the long term. So while we continue to improve, and there's certainly consensus here on these signals is a bullish signal, we still don't have that stack that we like to see that represents healthy bull markets. A much improved market, and certainly yesterday's action as we looked at the charts, very, very significant, and yet it's not yet that super healthy higher highs and higher lows series of moves on the charts that gives you something that looks more like 2013. We have not yet gotten to that point, so we're certainly not at hedge risk level 0. We're still at 0 plus normal with some elevated conditions. Position sizing models both now at 100%. Intermediate term market posture, severely strong bull with a strong bullish sentiment line reinforcing that. So these are certainly very positive. And you can see all 4 signals are now back to bull category, with the NASDAQ being a strong bull, still up under 80. That's a first day signal return on that. In terms of the strategy opinions, no changes on these yet. They already were in a position where they were, in quotes, granting permission to initiate new positions for novice traders as the opinion. Somewhat still defensive here. This I normally don't change this, but on weekly. But certainly you might start to want to use a bit more of the 2-to-1 ratio of in the money versus out of the money strikes on some of your new positions here as you go into the end of the week in selective places. In terms of volatility, specific warning areas, you see we have the volatility ratio that is set up for a new potential firing but is not yet fired. You also have this distribution day count on the NASDAQ, which remains stubbornly high at a 7, though other things have kind of resolved back down to the kind of normal setting. So these are two very kind of low grade, especially this one, low grade caution kind of area. And you just really have this one warning coming from the NASDAQ distribution day count. No warnings coming from the trend-based area. Everything here strongly bullish, though we still have persistent warnings coming at us from the intermarket risk aversion indicators, with 4 of the 5 indicators having recently crossed to the risk-off side. Also, from a sentiment standpoint, we're certainly getting extreme. You have short-term an 8, intermediate-term a 7, and you see the fear and greed index now an 83, up in very solidly into the extreme greed area. In terms of the performance yesterday, as you might expect with a big day like that, it's about universally green. Healthcare was the only negative sector, and it was frankly well off of its lows of the day. This was in part based on a tweet by the President-elect Trump that was indicating that he was still going to be, looking at holding down price inflation in the drug sector. Also, you had a decision by Congress in moving forward some legislation to accelerate the approval process of drugs and medical devices. So, kind of two pieces of information that moved this sector during the day. First down, and then something of a recovery back off of its lows. In terms of the other sectors, you see kind of a mixed bag of defensive sectors such as telecom, real estate, consumer staples, along with risk-on sectors such as infotech, consumer discretionary, and industrial. So pretty much it was a just buy everything, and with few exceptions on the breakout move yesterday. Okay, I think, let's see. Well, let's take a look at this. We continue to see healthcare as the weakest sector, utilities an improving but still also relatively weak sector, versus other sectors that have been continuing to be hot, the financials, the industrials. You heard one of the morning authors talking about transportation. Some of these other sectors have been consistently doing well. And you see on the 1 day, 5 day, 1 month, into 3 month, there's now fewer and fewer that are in the red, though financials continue to be very, very strong, and up 18% in the 3 month, up 20% in the 1 month. Also note energy, very, very strong performance during that time, followed by industrials perhaps as your third most impressive performance in recent time frames. Okay, that should be enough for today. Let's go ahead and roll this up. And I'd like to go ahead and get this published. I actually had to record this twice due to a mess up on the first time. It happens. That's part of the reason why we sometimes get variable times of getting this to publishing. You have no idea what happens behind the scenes putting all this together. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink at the bottom for the full set of disclosures. We'll see you back here next for tomorrow morning's market preview from Falcon Global. In the meantime, manage that risk profile and you'll see your consistency improve. And at the same time, also seek each and every trading session to go and learn something new about your chosen endeavor, investing and trading. Good trading.